Well, how about this? I'll go right to it. The bottom line is it's going to be pretty hard to cut rates after this latest inflation read. April producer prices, the PPI, that rose 0.5% month over month versus a 0.3% expected, with March's 0.2% month over month revised down to negative 0.1%. That was probably the good news. This is the highest year-over-year reading since April of 2023 and is the fourth hotter than expected headline PPI print. Core PPI was worse. It rose 0.5% month over month, more than double the expected 0.2% increase, which pushed the core PPI year over year up to 2.4%. Inflation is not under control. Producer prices are those prices that Walmart and Target pay to the producers to fill their shelves with products, right? Now, consumer prices, we get that tomorrow. That's what we pay Walmart and Target when we go buy those products that they put on their shelves. PPI is upstream of CPI. So either way, this is showing that the embedded inflation is going to be a problem. Yet the CME FedWatch tool still is talking about rate cuts towards the end of the year, maybe even September and beyond. And there are also those that think they're clinging on to the hopes of a cut before the election. It may happen, but I think if it does, it'll look really politically motivated. And traditionally, I think the Fed tries to stay out of that game. These latest numbers, they're not going to help that cause either, by the way. So my next guest, he talks about this stuff all the time. Please welcome to the show, Eddie Ghabour. Eddie, thanks for being on.
Thank you for having me.
Yeah, if you wanted a rate cut, you didn't like today's number, did you?
Not at all. I mean, look, the Fed keeps saying they're going to be data dependent. Well, the data is about as clear as it can get at this point in time, that inflation is not dropping like a rock, like some people are trying to lead us to believe. And we have a real risk of some major acceleration as we're continuing to see here. I mean, all you have to do is look at commodity prices year over year. And I don't know what the catalyst is going to cause it to come down other than a recession, right? Because in order to get prices down, you need demand destruction.
Yep.
So if the Fed cuts rates, I think it'll be a very big policy mistake that we'll pay a big price for later on next year.
I mean, you can read the research, and I try to read as much as I can. I feel like I'm a lawyer in this job. But, I mean, in order to see that demand destruction, there's folks that are talking about a 5.5% unemployment rate to really get to the level you need to be to really put this problem to bed, number one. Number two is the last time we were fighting something like this was, early 80s with Volcker, and he ramped them up pretty high, if you remember, 18, 19%. The difference is, Eddie, we can't do that today because our debt to GDP back in 1980 was 35%. Today it's 125%. We can't do it to ourselves. And then the last thing I'll say is this. When you pour $10 trillion into the economy and let 10 million people in at the same time, boy, oh boy, if that's not a powder keg of inflation, what do you think?
Yeah, I mean, look, this is just overspending. People ask, why hasn't inflation come in when the Fed has raised rates at the fastest pace in history? And it's because DC's working against them in regards to what they're doing by spending too much. And now we're going to pay the price for it. I don't think there's any way we're going to get to 2%. My guess is the Fed is going to ultimately have to change their goal and move the goalpost on inflation. Because, again, if you look at it logically and you look at the real world and what families are spending, things are getting tougher and tougher. And so I think the Fed's going to end up having to live with a 3% inflation. And I think we're going to have to get accustomed over the next decade to the new normal of rates being where they are, if not higher, and the cost of living being higher. So this is a problem that's been manifesting over the years with bad policy. And it's not something that's going to get fixed overnight. The only solution is something no one wants to talk about, and that is to crash the economy like Volcker had to do. And no one wants to be on the other end of that.
You're exactly right. And to your point about they have to stay at this level, for 50 years, the average Fed funds rate is about 5.42%. Last I checked, we're pretty much straddling that number right now, right? And I think that's something you're exactly right. People are going to have to get used to. And so you're right. The only thing that we're going to see that's going to make this any better is something that we can't talk about. It's unelectable. You can't go to Washington and say, I want to stop spending and get rid of your entitlements. There really ultimately looks to be nowhere out. And we haven't really started to address the debt issue either. And I think that's another powder keg that's waiting to happen. What do you think?
This is the largest debt bubble of our lifetime. And this is the thing that scares me the most, right? Because you look at our balance sheet, we look like a third world country. Yep. And the path continues to get worse and worse. And this is why, again, I think, unfortunately, the only way the capital markets will take over at some point in time and fix it for them with some type of major correction or some type of default, because we can't continue down this path. I think that's common sense. And they continue to ignore it. And now we're in the predicament that we're in now, where they're in a lose-lose situation, whether they cut or don't cut.
And don't you just think that people are, blissfully ignorant or whistling by the graveyard? Nobody's willing to have that conversation and say, this is 100% unsustainable. And the yield curve, once again, will be 100% right at some point in time, because the way you do the math, and I used to teach finance at the DePaul University in Chicago, and 2015, we did the books of the city of Chicago. And that's when the students realized Chicago's bankrupt. I mean, that's where our federal government is today, correct?
It is. And look, I think you're going to see some signaling in the bond market. I expect to see the 10-year Treasury, regardless of what the Fed does, to get over 5%, because the capital markets are going to take over. Who the hell wants to buy a bond for 10 years with our balance sheet the way that it is and get paid less than 5%? So I think rates are going to head higher. I don't think a lot of investors are prepared for that. Once we get through this, euphoria of this rate cut that may or may not happen, I think you're going to see the 10-year Treasury and Treasury bonds go much higher than where they are right now.
I can't argue anything different. I think you're right there, and that could be an opportunity for people with cash on the sidelines. But it's going to be a very different environment, and it could be actually very, very difficult as well. You said it the best you could. I appreciate you giving us the bad news like you did.